So the chair of this panel is Dr. Theodore Koshoyano, an associate professor in energy finance at University of Edinburgh. And Theodore's work is at the intersection between sustainability, data science, and finance. His focus on applying innovative research methods to the study of sustainable development issues. His work has led him to be invited as a member of the European Commission's platform on sustainable finance, where he advises the Commission on the European Union sustainable finance policy and on H&M, Her Royal Majesty Treasure's Green Technical Advisory Group. So, Theodore.
Hi, good morning, everyone. Thank you so much for the kind introduction, and thank you so much for having me, for having us here. Let me start with a few thanks. It's obvious the passion that is here in Luciada, and I think it's really obvious to see the passion of Luis and Isabel, and I must really thank Isabel for her passion. Ever since she visited in Edinburgh, she was the one driving, so today's event was planned about a year ago, where she said we really must do something, we really need to kickstart things, and they have to happen in Portugal. And it all has to be interconnected, and it was very apparent from the speech also of Luis in that openness, and I've personally experienced that openness to collaborate and to work, and for that I'm so grateful, and for all the work you've done to bring today together, and your commitment to do that in the future. So thank you for that. Now a bit about me. If you look at my CV, it doesn't make any sense to anyone, not even to me as I look back what I've done. I am trained as an electrical engineer. I started off thinking that climate change is an issue that we need to solve technically. We just need to design better solar panels. So you can imagine a quite naive undergraduate coming to study engineering and look at the solar panel design in Edinburgh. And then I found out, no, we know how to do these. They were already manufacturing them. So then I was like, oh, wait, that's not the problem. Then why, if we have the technology to save ourselves as humanity, why are we not doing it? And I just didn't get it. So then I started learning more about the world of finance, about how important data is, how important geography and context also is, and we often ignore that. We think we can generalize solutions pretty much everywhere, and that's not always possible. So why do I say that? I say that because I think theme is important, but what's also important is team. Why do I say team? Is because if you're going to look at the papers that are presented today, if you look actually, and Lucia will come up at the work of she'll present the work of the JRC as well, you need so many different areas of knowledge and expertise to integrate to solve sustainable development issues. You need engineers, you need financial data scientists, you need accountants, you need geographers, political scientists, and so on to come together to solve these issues. And so I really want everyone to reflect, and everyone online, thank you so much for joining on this idea on how you can collaborate outside of your field, because that will enrich you personally. And I know that's not always, I suppose, rewarded in academia, because we do have some tracks that still, I suppose, are very much looking in individual silos. I do think the solutions really require true teamwork across different disciplines, and I'm really delighted to be able to work with you, with Lucia, with Fabiola and Wen, and with Andreas also just joining, and he'll come soon on stage. Just before I introduce Lucia, I just wanted to say that after this conference, we would be delighted to follow up with a call for papers to the British Accounting Review. And again, I have to thank Wen, and you'll hear from him, from his keynote later. We do, all the themes and all the great papers that you've submitted, you will also have a chance to submit towards the special issue till the beginning of next year. It will be an extended open call to gather quite substantial contributions. So the event doesn't stop here. There'll be quite a bit of engagement on a lot of these research themes going forward. So with that, I'm delighted to introduce the panel. And the first one is Dr. Lucia Alessi, the team lead in sustainable finance at the Joint Research Center of the European Commission. Lucia, the floor is yours, and then we'll find out more in the panel, also more of the work of the GRC. So with that, I'll leave the floor to you.
Thank you. Thank you very much, Theo. And many thanks to Isabel and the organizers for inviting me to this terrific city and this wonderful event. So I will start with a short talk on the strategy of the European Commission for financing the transition to a sustainable economy. This is to give you a bit of background about the whole sustainable finance framework, if you want, as we have thought and worked on it for many years at the European Commission. Now let me try and make this. Does anyone know how you make this bigger on F5?
Is it F5?
Because I know it in other contexts, but here I don't know. H. So in this case it's H. Okay, very good. Okay, so how do I flip through this? Does it? No. Okay, so there are various pieces in the EU Sustainable Finance Framework. The cornerstone of the whole framework is the EU taxonomy for sustainable activities. So as you may know, the EU taxonomy provides the definitions of what economic activities can be defined green and under what conditions. So the taxonomy, if you look at the legislative acts, they are really long, few hundred pages, just like dictionaries, because they list economic activities with all of the conditions, so-called technical screening criteria, that need to be fulfilled for an economic activity to be defined green under the EU taxonomy. And this is very important because, as you can imagine, clarity about the definition is the basis for any further legislative initiative. We need to be clear, before we even finance anything, we need to be clear what is worth being financed. So the taxonomy is the cornerstone of the framework. Then there are a large set of disclosures. So we need to be clear that in the EU Sustainable Finance Framework, there is no obligation whatsoever to be green, to have a green business, to invest in green activities. Of course, everyone is free to do whatever they want as long as it's, within the boundaries of the law. However, there are quite several disclosure requirements, for example, for bigger companies, to be transparent and clear about how sustainable their activities are. So they are not forced to be sustainable, but they need to be clear about how green or sustainable they are. Then there is tools. So tools, there are a set of tools that make the life of investors easier whenever they want to invest sustainably. So these are, for example, benchmarks. This is, for example, the EU Green Bond Standard. So a set of tools that make investors save time and money because they increase transparency and provide opportunities to invest sustainably. And then more recently, the European institutions have also looked into ESG ratings, because ESG ratings and all that goes with them, rankings, all sorts of assessments on in the ESG performance of companies. So this is important information. As a matter of fact, investors do look at it. We know there is plenty of literature that shows that this has become an integral part of the decision-making process of investors. However, so far, this world of ESG ratings, again, there is lots of literature that shows that it's rather opaque. It's, really not too clear how come that an ESG rating of the same company is high from one provider and it's much lower from another provider. There can be difference in models, of course. It's legitimate that one rater gives more weight to a dimension and another rater gives more weight to another dimension. But the point is that this needs to be clear to the users of the ratings. It cannot be a black box. So this is another piece of the framework that we have been working on. Now, coming to the strategy that was launched in 2021 by the European Commission, to complete the work that started in 2018 with the launch of the Action Plan on Financing Sustainable Growth. So in 2021, the Commission launched this renewed strategy, if you want, which is structured in 4 main areas, if you want. One is to continue work on the tools and policies that enable investors and companies to transition to a greener economy and to finance this transition. Another area has to do with including also SMEs in particular and households, individuals, into the sustainability discussion. In particular, in Europe, we know that the role of SMEs in the economy is very, very important. So we are now working very much towards also providing SMEs with the right tools that they can use, which cannot be, of course, as complicated as the ones that we have developed for larger companies. But they need to be there. Another big area has to do with the financial sector, both on the front of enhancing the resilience of the financial sector to the transition, so the so-called risks that are related, for example, to climate change, but also to nature degradation. And on the other hand, also increase the contribution that the financial sector can and should give to financing the transition of the economy. And then there is the 4th area, which has to do with scaling up the global ambition of the European Union. So to bring in international fora the issues that we have been working on and promote an international consensus for an ambitious global sustainable finance agenda, because we know that these issues are very much global, so they need to be dealt with at a global level. Now, let me quickly go through the various areas. So, with respect to financing the path to sustainability, what the Commission is doing is to develop a more supportive framework for the financing of, the transition, to reduce significantly the impacts of economic activities that are harmful with respect to climate change and to nature as a whole. So in the first place, what we are doing is focusing also on activities that are not already green. So sustainable finance is not only about financing activities that are already green. That's fine, of course, but a large part of the economy is not there yet. A large part of the economy needs to transition from different starting points. There are companies that are operating at intermediate levels and they want to become greener. There are companies or activities that are operating at levels that are really not compatible with a low carbon economy, and they need to put even more efforts into improving their environmental performance, but for that they need to be financed, they need to be helped and supported. In the meanwhile, since 2021, when the strategy was launched, the Commission has extended the EU taxonomy by including more and more activities into the taxonomy, and notably last year the taxonomy was extended with a large set of activities that are green, not with respect to climate change mitigation and adaptation. So these were the two objectives for which we had already a long list of activities, but with respect to other dimensions that relate to circular economy, to water resources, ecosystems and biodiversity, and pollution. So now we have, I would not say a complete taxonomy, because activities can always be added, and in fact we are still working on other sectors of the economy that we have not covered yet. So the taxonomy is continuously evolving, but at least now we have activities that are relevant for all of the environmental objectives that we have in the taxonomy. And another area that we're working on is on extending the framework of sustainable finance standards and labels. So for example, we are thinking about sustainability-linked bonds, ESG benchmarks, and green loans. So all of these need a definition, right, in the law, and that's what we are working on. Now, moving to the second action that has to do with SMEs and individuals. Well, here there are many different sub-actions. In particular, for example, empowering retail investors and SMEs. So this means, for example, here it comes again, clarifying what is a green loan, what is a green mortgage, so that banks know that these products can be classified as green assets, and working on advisory services that are, of course, crucial for households and SMEs, leverage the opportunities that digital technologies can offer for sustainable finance. So, for example, with respect to integrating ESG data in data spaces, for example, the ASAP, the European Single Access Point, where ESG data will also be included. And again, digital solutions for SMEs and retail investors. And then other actions that have to do with insurance, green budgeting, and so on. Now, let me quickly move to what we have done with respect to the financial sector. Now, this slide is on the double materiality concept, which is a concept that is very close to the heart of European institutions, not as much in other jurisdictions around the globe. Now, so the double materiality approach essentially means that both dimensions need to be looked at. One is the dimension of the outside-in dimension. So if you look at a company is subject to some financial risks that may also come from the sustainability dimension. And on this, everyone agrees. However, what we claim in the European Union is that there is also another side of the coin, which is the inside-out dimension. So anything that has to do with the impacts of a company's business on people and the environment. And what we claim is that this is also important, this is also material, because ultimately this inside-out dimension can also have financial implications for the company. And I mean, again, there is plenty of academic literature that shows that, ESG incidents, scandals, reputational issues, these have a financial impact on the company. So this is what we claim in the European Union, that both are important and disclosures need to cover both aspects. So what are we doing to improve the resilience of the financial sector to shocks that may come from the sustainability dimension? So, for example, asking financial institutions to be more transparent on the risks, on sustainability risks that they are subject to in their financial reporting, and also to consider including this in credit ratings. So all of this is done, of course, in cooperation with relevant European supervisory authorities. And so essentially what we are asking is that relevant ESG risks are systematically captured in risk management practice, in credit ratings, and so forth. What we are also asking to banks and insurers is to identify and manage these sustainability-related risks by integrating them in their risk management systems. And also, with respect to a more macroprudential view, what we want to do is to strengthen the medium to long-term financial stability, the stability of the financial system by, for example, asking the European supervisory authorities and the ECB to run regular climate stress tests, which they are already doing. And we are also, as Commission, we have also asked them to run a one-off exercise, so-called Fit for 55 exercise, which I actually know quite well because as Joint Research Center of the Commission, we are observers in this process. So what the ESAS and the ECB and the European Systemic Risk Board are doing is to run this huge climate stress test exercise for the whole financial system in the European Union with a top-down approach to actually assess whether the European financial system is vulnerable potentially to shocks coming from the low-carbon transition, so-called transition risks. And so this means looking at the exposures of the financial system to particular sectors of the economy that in the low-carbon transition might suffer, for example, all of the sectors that are related to fossil fuels, from oil drilling to refineries and so on and so forth. So if as an investor, you are heavily invested in these activities, or you are thinking of opening and financing a brand new coal mine, of course, that's not particularly smart, and that puts a huge risk on your balance sheet. So this is the type of analysis that we're doing, and the results will be available by the end of this year or early 25. And these analyses are now extending very much beyond climate, so to also take into account risks that come from biodiversity loss and ecosystem degradation. Of course, that's even more difficult than with climate, but we are working on that. Now, to increase the contribution of the financial sector to sustainability, we are so what is mentioned in the strategy is improving science-based target setting, disclosures, and the monitoring of the financial sector commitments. So all of these net zero alliances, what does that really mean in practice? What is your target as a financial institution? Does that mean that you are really working towards net zero? I mean, to ask a bit more, bit more questions about this. Then there are also actions that have to do with fiduciary duties and stewardship rules. And there are also actions that have to do with improving, indeed, the availability, integrity, and transparency of ESG research and ratings. And on this, we have a regulation now. There are other relevant points about the financial system. One has to do with, greenwashing. There is huge greenwashing now out there. It's a big problem. So what we are doing together with the ESAS is to monitor greenwashing risks. So to develop tools, there are, for example, tools that are based on text mining that have been developed by ESMA. So we also need to think, from a scientific perspective, how we can do this properly. And with respect to monitoring the transitions, of course, that's also important. We need to know where we are at each point in time, how closer we are getting, if any, to the targets that we have set ourselves. We need to translate these targets, from CO2 emissions to what it means in terms of portfolio allocation, and that's also not easy. So in order to do this, there are a set of regulatory actions that we are undertaking. And what we have done as Joint Research Center of the Commission, so as Commission, but this has been launched and managed by the JRC, is the establishment of a Sustainable Finance Research Forum. So this is a platform that we use to foster knowledge exchange between researchers and the finance community. So I will maybe explain later that as Joint Research Center, our job is really to work as an interface between policymakers, academia, industry, and all of the relevant actors that sometimes do not really talk to each other, but it's actually very good that they start talking to each other because the industry desperately needs tools, rigorous scientific tools to navigate this new environment. Policymakers also need scientific evidence to shape the policies. Academics sometimes, let me say, sit in their ivory tower, but actually in the real world there are people that are facing issues, so it would be nice to help each other. So this is why we have established the Sustainable Finance Research Forum. And finally, with respect to the global ambition that we have in the European Union, as I said, what we are doing in international forums is to promote an ambitious consensus. We have established already back in 2018 the International Platform on Sustainable Finance, which has been expanded on new topics and strengthened. So this brings together very many members across the globe, representing more than 50% of global GDP, and so it's a very powerful platform for seeking consensus at the global level. And finally, another very, very important topic on which I don't have time to elaborate more is supporting low and middle income countries in scaling up their access to sustainable finance. Because in a way, if you want, I mean, it's already difficult to promote sustainable finance in the EU, where we are actually quite advanced. I mean, we can think about, you know, producing energy in a green way or implementing a more efficient production processes. But if you think about low-income countries where they don't have pretty much anything, have other issues to think about, but that's precisely where it's even more important to scale up sustainable finance, because most of the emissions actually happen elsewhere than in the European Union. So this chapter is actually crucially important. And as European Union, we have set up funds to help concretely these countries to scale up sustainable finance. And we're actually thinking, via the establishment of a high-level expert group and a whole strategy, how to actually promote technological transfer, for example, and, you know, a set of actions that actually bring sustainable finance to the ground also in low and middle income countries. So this was it. Thank you very much. Shall I sit?
Thank you so much, Lucia. So much food for thought, and we'll delve deeper in a lot of the insights. I also heard that ChatGPT apparently uses the word delve a lot. So one way I just used it just to to prove that humans use it too. But the word delve is used apparently a lot in large language models. Before I invite Andreas up, can I confirm that his presentation is loaded, or yeah, you also have it there. Okay, so let me invite Andreas. So I'm really pleased to also welcome Professor Andreas Hopner. He's a professor in operational risk banking and finance at University College Dublin. He's also the person who inspired a young engineer to join the call for battle in the sustainable finance space, and I'm delighted that he'll be presenting on Paris-aligned benchmarks, of which he's a co-inventor of in the European Union's data science hub. So, Andreas, welcome, and thank you so much for coming.
Thank you very much for having me. Is the presentation already on it, or do we?
I think.
Otherwise, edit from me. You have it already? Oh, you just take the first one. It's there. The first one. First. Yeah. Okay. Perfect. And then maybe full screen. Excellent. Okay. Thank you very much for having me. It's a pleasure to present and speak after Lucia, and she very nicely introduced the framework. I will just speak about two things, tools, one being Paris-aligned climate transition benchmark, and the other one being taxonomy-aligning benchmarks, which we're consulting on right now. So overall, the question of how to achieve the Paris Agreement in investing is a question of how to walk the walk rather than talk the walk. That's not my words, that's Alan Decker's words, who in ESMA runs the unit on SFDR, but it is quite the case that a lot of the investment funds previously have talked the walk. They talk green, they talk climate change mitigation, then they talk climate change adaptation, then they talk nature, and next year they talk the next thing, but don't dare looking if they're walking, right? The marketing teams really don't like that. And there is a narrative that what happened in the last 10 years of mainstreaming sustainable finance is really that the entire marketing teams picked up sustainability as the #1 campaign, but they're still marketing teams. They ain't sustainability teams. So we're needing to actually walk the walk. What does that mean from a Paris Agreement perspective? Well, the necessary and sufficient condition from the Paris Agreement is decarbonization. It's as easy as that. When we launched the Paris line benchmarks, we said 7% reduction per annum every year. The UN emission gap report, the IPCC scientists later that year for the sovereign suggested 7.6, but somewhere in that realm, annual decarbonization. Then, of course, that alone might not be particularly sexy. We might find ourselves in a situation where we may well lose at the ballot box. So in essence, the electorates of the democratic countries think that's a pretty harsh diet to always diet, and there's nothing innovative, nothing green, nothing exciting. So we also, which is a necessary but in itself not sufficient condition, need to actually green our economies. And we need to really discuss what that means. Because the financial metric here, when we're looking at the taxonomy, is more important than anything else. If we're declaring revenue green, let's hypothetically say we declare this coffee green. May or may not be the case, of course. But in practice, we're just legitimizing corporate action. We're not raising new funds there, right? The people that pay for that revenue are legitimizing corporate action. They put them in a decent position. That's all good and nice, but it's not new funds. If we're declaring capital expenditures green, we're raising fresh new cash every year for the actual green transition. And what Lucia already outlined in her speech is that the actual rule book, the green taxonomy, took ages to construct, created a lot of controversy because it's actually quite hard. It is really hard to have capital expenditures that fulfill substantial contribution and do not cause significant harm on anything else. So the single most important number is how much capital expenditure can the European Union and our European member states, possibly some countries abroad, actually bring up to the green transition every year. And I'm pleased to say as of now, and these are numbers we've just calculated, we're looking at about 240 billion per year. That's quite a lot of money. We're not yet at $1 trillion, but you can add this up. Taking this for 3 years, adding the Paris line benchmarks AUM, which is not a per year thing, but it's a total amount of money, is nearly 200 billion. So in 4 or 5 years, we're actually at $1 trillion. And that only happens with CapEx. $1 trillion revenue is just making companies feel good about themselves. That's a nice thing, but doesn't actually transition in any particular way. So to explain that step by step and then to come to the taxonomy lining benchmark we have consulted from December to March, let me go through the overall. So when I look at an investment strategy, historically, we have reduced emissions versus the benchmark. So we're 30% below benchmark in emission intensity, but we're not walking the walk necessarily. If the benchmark increases in absolute emissions, we may increase in absolute emissions as well, but still being 30% better than benchmark. Right? Market teams love that. It's an easy claim. They don't really have to work hard for it. Then what Paris line benchmarks introduced was the actual ambition to reduce vis-a-vis yourself. So a self-enhancing benchmark, 7% year on year, targeting net zero by 2050. Now the very important aspect was carbon emissions, where the US have tried but not yet got there, is that you have to include scope 3 emissions. Because if you do not include scope 3 emissions, you're tinkering around the symptoms, you're not looking at the causes. Oil and gas in only scope 1 and 2 doesn't look that bad. Evidently it's the cause of climate change. Utilities in scope 1 and 2 simply because you use it, otherwise it would look worse. So we do integrate full scope 3 emissions in a staged approach to acknowledge data quality. It's 2020 fossil fuels and mining, 2022 by the end of the year always it's any heavy industry, and by the end of this year it's absolutely any industry. But when you integrate scope 3 emissions, you have to ask yourself, what are we doing with all the companies that do not report or that report substandard, meaning they underreport? And here it's hugely important to have the precautionary principle as a guidance from the United Nations, which means if in doubt, err on the side of the planet, not on the side of the company. So if in doubt, overestimate rather than underestimate. That incentivizes the companies to actually start reporting themselves, because the number they get is worse than the number they would collect. If you do the opposite, if you do a naive estimation for a point estimate as we normally do in econometrics, because most of the data is underreported that you're using, you will actually produce an underestimated figure, which will disincentivize companies to report, causing all sort of issues on that. We have significant data quality issues. CalSTS, the California Teacher Pension Fund, has just delayed their carbon footprint by a year because they're struggling to handle the data, which then generated headline news when they just put it on the agenda of their board meeting. So this is where we'd like to go on the decarbonization as a necessary and sufficient requirement to reach the Paris Agreement. I'll show you later also how we're looking at the greening the capex, which is not in itself sufficient, but very much a necessary condition to actually win at the ballot box. So, and where do we stand? Paris-aligned benchmarks are Article 9 funds. In the fund regulation, we have over 100 billion euro. We have in fact 180 billion euro as we speak. Hundreds of indices and ETFs, so all different regions. And we have both a return on investment, a sufficient financial performance return per unit of risk, which is pretty good, and a real impact outcome, greenhouse gas reductions, which is also pretty good. I might look a bit tired because I spent my night on TAP 232 over the Atlantic, but I did that so I could present to the World Bank Pension Fund just before about that very topic, pretty much the same structure, and the World Bank Pension Fund also very interested in discussing. I presented to them 4 years ago. I had 6 in the audience. This time I got 20. So it's definitely a lot more interest within the World Bank in that topic. Just the TAP 232 is still not a good way to spend the night. Now, across all universes, and what I mean by all universes is the global universe, the developed universe, the emerging market universe, the EMU universe, the US universe, like there's 25, 30 universes index providers like to use. This is a development of Paris-aligned and climate transition benchmarks, mandate and funds. Paris-aligned benchmarks leave 50% of the buffer for future innovators. Climate transition benchmark leaves 30% of the buffer, and then they both decarbonize 7% year on year. As you can see, it's pretty much a success story since the beginning. We have about 180 billion in euros, 194 billion in dollars, if you look at this slide, and it goes up. But the very interesting aspect here, if you look at different sub-universes, it is absolutely not linear. So depending on the sub-universe, it's either an issue of mandates or funds, or an issue of PAPs or CTBs. Now, if we go to the developed market sub-universe, you will see the green bar is growing even more that are PAPs. So in developed markets, we use Paris-aligned benchmarks. That means we're actually excluding fossil fuels, no more than 1% revenue from coal, no more than 10% revenue from oil, no more than 50% from gas. And climate transition benchmarks started strong because MSCI in particular turned all existing benchmarks into climate transition benchmarks, but they fell a bit. Side note, in the US, they have 30 billion in climate transition benchmarks, but in the political climate, they call them ESG enhanced. So it's taken out of the name, so no one thinks it's made in Europe, and no one, God forbid, think it would be too politically anti-ESG. Now, what do you think that looks like in an emerging market universe, right? There are some lobbyists, such as IIGCC, running around saying, oh, it's difficult for emerging market without necessarily changing the data. In an emerging market universe, it's the other way around. In an emerging market universe, it's the climate transition benchmark. This transition that rises, and basically fossil fuel exclusions in emerging market universe are seen a bit too premature. That makes a lot of sense. So in essence, the PUP numbers have more or less settled in emerging market universe, but here the CTBs are rising. If we're then looking what happens with the global universe, so really reference benchmark for all your assets, then it's the mandates. So it's less about funds sold to retail investors, very much separate mandates sold to institutional investors. So we have the tool, it's growing well, and it is flexible. Whenever we talk transition, we always forget we have already climate transition benchmarks, and they're very popular for emerging market universes, and 7% is what we need to scientifically achieve. It's understandable that fossil fuel firms lobby against that. Obviously, it's very much their commercial interest, It's not always understandable to me if other industry associations are not really following the science there, but then it's up to them. Now let me show you the capex numbers, and particularly the countries. We have 244 billion capex, that is most recent fiscal year, so for some companies that's 2023, for others it's 2022. I have flagged with EFTA the non-EU member states. And the very interesting aspect here is Germany is there with 65 billion on top, but then already comes Norway with 40 billion. So the second biggest amount of green capex comes from a non-member state that, however, is very sustainability interested. Spain is very strong in this campaign, effectively second among EU member states, 37. Then comes France on 26, Italy on 23, big drop to the UK on 11. Denmark, Portugal, very high up, I would say, on a per capita basis is probably, rough estimation, yeah, but maybe even the highest on a per capita basis. I should have done that, sorry for that. Actually, sorry, no, it's not going to be the highest on per capita basis because that's going to be Luxembourg, I think. But then there's a lot of interaction between Portugal and Luxembourg anyway, right? I tried to fly from Luxembourg to Dublin, and it's amazing how many more flights there are to Lisbon and Porto than to Dublin. So, but it's pretty high up. It's very strong performance for Portugal for 6.8 billion. And always keep in mind, this is essentially fresh money that gets repeated more or less the next year with a slight growth curve, right? So it's a very good news story. The only ones where we can't find data yet is Latvia, Malta, and Slovakia. Well, Malta we can maybe understand. It's only 2 listed companies in their stock index. Now I'll represent this in a visual way here. You can basically see it's going pretty well across the world. Now, however, the challenge with that is that, in essence, outside Europe, we'll have very little. We have like individual companies in the US, Mexico, Chile, Canada, South Africa that take an interest, but we don't have big numbers. If American, Asian companies have more than 50 million in revenue by 2027, they'll have to report 2028 in their largest European subsidiary. Now that's a bit the catch. If they are really not wanting to report, they just split the German and the French so small that they're fall below the threshold, because everything is triggered by your largest subsidiary at a 50 or 40 million revenue value. And so, do I have 3 more minutes, Theo? So, in essence, to just summarize, I'm not going to go too much into the technical details, but we find ourselves in a situation where what we'd like to do is to decarbonize and green the capex. And the first thing to consider here is, of course, not every company is a capex company, right? Essentia in Dublin would be perfectly happy to buy 100% green capex. It'd be 2 wind turbines outside the office building, right? So that would be fantastic in numbers, but meaningless in total. So we define companies in 2 groups. Those companies that have capex intense securities and those that don't. And in fact, we define it on a security level. So a bond could be capex intense when an equity is not, maybe because the valuation is crazy high, because of course in equities, essentially you're dealing money between investors. The only real way for equity to generate impact on cash flow is via acquisition, because the main acquisition currency are shares. So we say if the nominal capex attributable to the asset class divided by the market value is more than 1%, you're capex intense. If not, you're basically not relevant for capex. And then we're saying it'd be very nice if on the capex intense side you can get gradually to 100% green capex, ideally by 2043, 2040. Scientifically, we'd have to reach it way earlier, more like 2030, but that simply ain't realistic for markets right now. And so then, the 7% decarbonization gets interacted with the capex growth. If I'm growing 100% green capex in a given year, I don't have to decarbonize. I can decarbonize plus minus 0. If I grow 50%, I can decarbonize 3.5, and so forth. So if I only have 10% green capex, my decarbonization is 6.3. So we're bringing together both a necessary and sufficient condition to decarbonize, as well as a necessary condition to actually green the capex. In the interest of time, I'm not going to go through all the technical aspects, but let me just show you how this would look overall. We basically extend the blue decarbonization line by 2 lines to actually green the capex. The dark green line is a 5 percentage points increase line for the European universes, the EMEA universes, where this is very feasible. The light green line is for a global universe, an Americas universe, an APAC universe, where we simply don't have the data yet. So it's a 1.5% accumulated continuously compounded function that basically gives them a lot of time to catch up on the data. But that way we have taxonomy aligning benchmarks with or without exclusions as essentially, if you want, so a sibling to Paris aligning climate transition benchmarks. They won't decarbonize as fast, obviously because they give decarbonization holiday, also because they start from ±0 rather than -30 or -50, so they are not necessarily that fast in decarbonization, but they will very much encourage further greening. And that is the key number. The 244 billion that we have right now, we need to globally scale that, and at some point we need to hit $1 trillion a year. That being said, we are likely going to hit $1 trillion total by 2026, which is already pretty good. The contrast to this is that 5 years ago, you would find it incredibly hard to get a green capex number from any firm. So to give you the feeling, you walk through a gangway at Heathrow, the advertising of an oil and gas company is 99% green, but the capex probably less than 3% green. Right now, you have companies, now I use a German company, and I'll admit bias straight away here. RWE doesn't have the best reputation in Germany, but the numbers on the green taxonomy look pretty good. 13% green revenue, it's all legacy business, hard to twist, but 83% green capex. And that's the type of firms you want to look for that have a lot more green capex than they have green revenue. And just to be very clear here, green capex numbers are great. Green revenue numbers, a little bit of a measurement validity issue because the do no significant harm ones are very difficult even for the companies to measure against the revenue. And then on the green OPEX side, it's at the moment all operating expenditures, so it's great if that was all green, but that would include CEO bonuses and Christmas parties, which leads to the question how we actually do that for Christmas parties. So really, it's the capex that matters by far the most. And the numbers look the best, better than revenue and OPEX, and they look as if by 2025, latest 2026, in total, certainly together with PUBs and CDBs, we will have reached 1 trillion fund raised for the green taxonomy, which I think would be pretty amazing. Thank you very much.
Thank you so much, Andreas. So as you see, we have a lot of food for thought. Lucia gave a great presentation about the master plan in Europe. And then Andreas, as always, gave a great insight into one of the tools, which are actually now it's almost 4 of the tools, right? So the climate transitions benchmark, Paris aligned benchmarks, and you have the taxonomy aligned benchmarks, which also has variations underneath it. So something to emphasize from this policy academic interface is this is also something we'd look for in the special issue. So with anyone having ideas on understanding the impact of the sustainable finance package, of the different tools, any questions on how we can counteract and detect greenwashing, which were mentioned heavily, are very much encouraged, and we think about that a lot. Now, we have a treat in that for the next, I think, another 25 minutes, because we are in time. We can hear more from Lucia and Andreas. So I'm going to take a bit of a step back so we get to know them a bit better and then relate to their content. So I'll start maybe with Lucia. As Lucia gave us a presentation on sustainable finance package, but we didn't learn yet a lot about the JRC. So Lucia, would you like to get us started, please, on your work in the JRC, the sustainable finance team, and how it contributes to the big European plan on sustainable finance? Thank you.
Thank you very much, Theo. So let me indeed start off with explaining what the Joint Research Center of the European Commission is and what's our mandate. So the JRC is the largest Directorate General of the European Commission. So it includes almost 3,000 staff. It's located in 6 different sites in Europe, and including Seville, Karlsruhe, and other sites in Belgium, the Netherlands. And the largest site by far is located in northern Italy, not far from Milan, on the shore of Lake Maggiore, actually. And about 2,000 people work there, so it's a very, very large site where, and it's highly multidisciplinary. So at the Joint Research Center, what we do is to provide scientific results and technical advice for the development of European policies. And we do this across the board. So the Joint Research Center was founded with the Euratom Treaty, so most of my colleagues, hundreds of colleagues, work on nuclear energy actually, but we also work on health, we work on environmental science, and also on increasingly on social sciences, and therefore we also have economists. And among economists, there are also myself and my team who work on finance. And we are particularly strong and focused on sustainable finance. We have started already since 2018 to provide support to the European Commission for the development of the sustainable finance framework and all of the relevant legislations. So I am quite proud of saying that we have been among the very first institutions, including policy institutions, so all of the central banks and supervisors, and also academic institutions, putting a lot of effort into developing science for sustainable finance. Now, as I said, at the Joint Research Center, we are highly multidisciplinary. We work on many different angles of science. And that's why actually the JRC is the ideal place as an economist to work when you work on sustainable finance, because as Theo mentioned and in the introductory speech, you need really to work together with engineers, with environmental scientists in order to develop science for sustainable finance. And for example, at the Joint Research Center, we have the Knowledge Center for Biodiversity, where, you know, my colleagues who are not economists work on biodiversity loss, and they have great data, for example, on, you know, how many frogs from that given species live in this particular forest, and how many they were 1 year ago and how many they are now. So building on this very granular data, what we are actually starting to do is to think about, you know, actually calculating, monetizing the impact of biodiversity loss, and ideally bringing it down to the firm level, because that's what we need for doing financial analysis. At the same time, for example, at the Joint Research Center, we host the Risk Data Hub, which is the reference platform at the EU level for data on natural disasters. So, and this is open source, of course. So this is data that one can access, and it's we have very, very granular maps on historical data on natural disasters, and we also have scenarios and risk assessments. So what we do, what we have done already in several papers, like economic papers and finance paper, was to bring together these very granular data on natural hazards, climate-related natural hazards, in order to assess what's the exposure of insurers, for example, or banks through their mortgage portfolio to properties that are in regions that are at high risk, for example, of flood. But then, of course, you need to do this very much hand in hand with the colleagues that work on this data, because I mean, this data is difficult data to understand and to manipulate. There are, for example, different underlying scenarios for risk assessments, the 1.5 scenario, the 3-degree scenario, and of course, the depth of the flood can be very, very different, so the damage can be very, very different. And if you allow me, this is also why I would advocate really for the use of public, open source, and rigorous scientific data in this analysis. We know that there are out there many data providers that provide similar analysis, but they are often also rather opaque, for example, on the type of scenario that's underlying their assessments, while that's a very crucial ingredient of the analysis. Anyway, just to conclude, we at the Joint Research Center of the Commission work on very many different disciplines. We have huge labs, we also have economists. What sometimes it's a bit tricky to, in such an environment, it's a bit tricky to convince the audience that what you're doing as an economist or a finance economist is actually important and worth being financed and worth resources. Like everyone, also in our institution, of course, we are quote unquote competing for resources, for visibility. And what typically happens at the JRC, which is also what makes my job interesting, if you want. I mean, we can never relax because, you know, if we go to senior management and my colleagues come and so what are you working on? And they say, well, a cure for cancer, very good. Next, what are you working on? Small modular nuclear reactors, cool. Next, we are working on very efficient solar panels, great. And you? I'm working on banks. Investment funds. So you see, despite we are all convinced, as Theo said, that if we do not move the trillions in terms of investment into sustainable activities, we are not going to get clean energy, we are not going to get efficient production processes, we are not going to get resilient buildings to climate change. So all of this needs financing, but every day we need to make clear that that's what we are after as finance economists. So yeah, I would leave it at that.
Thank you so much. And it's just on your point on data. The JRC has a huge data repository, so maybe we will find a way to disseminate that widely to the academic community. I made use of it myself on quite a few. They have fantastic and extensive data sets which really cover the globe, so from satellite to really bottom-up inventory data. So maybe that is something we can follow up post conference. So let me. I'll come back to you on a specific part on the content, and maybe I'll just turn to Andreas into kind of getting into this side of data. And discuss the CTBs, and we'll come back on this theme of data and estimates, because what we see is a huge innovation now of data and disclosures that are put in the right frame. For example, data on CapEx that give us a clear framework on how to achieve the goals, right? We're not walking in the blind anymore. So, Andy, I wondered if you could expand a bit into this. And you mentioned already of how the taxonomy aligned benchmarks versus the Paris aligned benchmarks, they complement each other in the vision, but I wondered if you could expand a bit on their actual interaction, because I think it's a really important concept for start.
Yeah, so I'll expand a bit on data and on the incentives behind the data. And Lucia already kind of pointed out a little bit that we should really use scientifically measured data rather than green painted data. And unfortunately, there's a lot, for instance, in terms of temperature degree measurement of companies or funds. At some point, one of the big vendors had Tesla at 2.13 and a big fossil fuel company at 2.11 degree. And while you can basically maybe say that Tesla isn't doing as much as it should, the accuracy of claiming 2.11 degree, even they thought it was a bit ridiculous. So now the whole thing is 2 to 3.5 degrees to make it a lot more less accurate. And the problem with the data is that the best data is the one that doesn't have marketing associates shouting about it. It's the scientific data, which you need to know and find. And then there is a data that wants to be sold, and that has a lot of people putting green paint on it and shouting about it, and it tends to have a lot of assumptions, and it tends to also have issues with IP. Quite often when we develop Paris line benchmarks, which was nothing else than saying we're doing minus 50 or minus 30% initial decarbonization, then we go 7% year on year, I would have thought there were so many NGOs trying to develop stuff. Why did no one do this very simple, quite obviously scientifically accurate recipe before us? And the answer is IP. Even the so-called non-for-profit NGOs such as 2° and others wish to develop something that they can IP protect. And then you automatically end up where we currently are for climate transition plans. We have over 60 different climate transition plan assessment schemes out there. Some people say that maybe more climate transition plan assessment schemes than credible climate transition plans. And so it is quite important to focus on the actual data that matters: capex, CO2e emissions, women among top management, for instance, on the gender side, matters a lot more than women on the board. It's full-time where it matters. Then necessarily take all the detours that are sometimes really funded by lobbyists to get people on a bit of a detour track, right? Take climate transition plan is another ambition to actually talk the walk before having to walk the walk, because you're assessing the plan, not the evidence of decarbonization. And so right now, to actually link everything to the data that we have increasingly available and use that is, I think, where we as a scientific community can do a lot to connect and get people to focus on the data that matters rather than running around the green marketing bandwagon.
Can I ask a question?
Absolutely. So,
I think it was a very interesting presentation. Thank you. When you present the comparison between different countries, that was very good for us, because usually Portugal does not come out very well. So we are very proud.
We go back to the
So
slide,
you should repeat that slide many times across the world. Please don't forget that. But do you have the figures for US? Where is US if you compare with that? That's first question. Second question is, I understood very well. I think you were very clear about the importance of green capex. That's good. But then you gave, let's say, less importance or less relevance to green revenues. I'm an engineer, and I think revenues concern very much the production mode, how you produce things, how you go ahead. Is that so? Is not important also? What are your comments?
I'll start from the back of your question. Revenues ain't financing. Revenues is the current operation, it's not financing, and it's not transitioning in any way. And to be fair with the existing companies, revenues in many cases are legacy business units, which you can only turn around as fast as big tankers. You cannot change much, and it's not fresh cash either, right? So capex is fresh cash. That's really shifting the trillion. Revenues have very little to do with shifting the trillion. Operating expenditures have even more to do with shifting the trillion. And if we were to limit operating expenditures purely to materials and wages, excluding bonuses and Christmas parties and whatever else, I think we had a pretty good metric there. On the operating expenditures, we may just need to reflect a little bit what isn't really a green operating expenditure. Because it is true that right now you have maybe 3 companies that claim to be 100% green on capex, revenues, and opex. And I get a little bit of a concern there, because that Christmas party, was that really that green? Like, did you only eat vegan food? Was the actual tree really that green? I mean, maybe green in a different way. So in essence, I think we need to be very clear that the central metric for if we're successful is capex, and it's exactly, and it's hugely more important than the other two. I would argue it's more important than the other two together, and then we can argue if it's revenue or opex as the second most. Depends a little bit on if we're cleaning up the opex. Now, the US on these numbers is included, but numbers are not shared anymore. But it's basically it's not there. So the Inflation Reduction Act is great in terms of subsidies. It's fantastic. The EPA has just handed out 14 billion to 3 kind of impact investment type organizations as grant. Like Climate United got a grant of 7 billion. Ever having applied for grant, it sounds like crazy. You get a grant of not a loan, of 7 billion. And that's 35 people in Climate United who now wonder what we do with 7 billion. Like running basically the whole distribution to the US economy. But in terms of actually turning the capex on a standard as rigid as the EU Green Taxonomy, that is not what is currently viable in the US political context. In fact, the nickname for the EU Green Taxonomy is Napoleonic Code, because that's way too rules-based and way little subsidy-based. But then, of course, the Inflation Reduction Act was fantastic and has, of course, a lot of competition that we need to acknowledge for companies looking at possibly going into the US. So, for instance, take Northvolt as an example, Swedish, highly PE-funded, VC-funded, highly leveraged battery manufacturer, big bet, but could work, could not work. I would certainly understand that they would have looked to go to the US, but then eventually Germany, northern Germany, with all sorts of promises, including a separate train line, got them to come to northern Germany. So, yeah.
So, on the Q&A side, what I'll do is just transition a bit also to Lucia, and we'll welcome questions after Lucia's intervention from the room, but equally from people online, and really grateful for everyone joining online. Just on the issue of CapEx, you can always fundraise against your revenue, but you need to make sure that you fundraise for the right thing as well, because you could still have companies making progress on revenue, but then spending CapEx the wrong way, and then reverting back to an unsustainable business practice. So from that perspective, the trajectory is set. That being said, the data is getting better in some respects in Europe, but as we're looking at the world, we're looking at companies with footprints, again, around the world, then estimations become very important to understand what is actually going on. So, the Chair, from your perspective, also as a policymaker, how do you make use of data and estimates to arrive to some sort of wisdom on what the way ahead should be?
Thank you, Theo. So the issue of estimates is one of those where a scientific contribution from the economic discipline is most needed, because it's also one of the hottest points from a policy perspective. Now, looking at where sustainable finance regulation stands, in many cases, the use of estimate is not allowed. And like, for example, if you look at all of the disclosures that are connected to the taxonomy, the regulation asks that both non-financial companies and financial companies only report data based on official disclosures. So in particular, banks and investment funds cannot estimate the taxonomy alignment of the part of the balance sheet on which they do not have information. So typically on non-EU companies and small and medium enterprises, given that these particular actors are, of course, not obliged to do any disclosure about their own taxonomy alignment, be it because they are non-European, so of course they cannot be subject to European law, or because it's small and medium enterprises, so they are too small. At this stage, they do not need to declare their own taxonomy alignment, so the bank cannot know for sure. And at the moment, the regulation says that the green asset ratio, so the alignment of the bank, should only be computed based on, official disclosures. However, that's still a bit of a contentious point, because that means that the coverage of these disclosures, but also not only in the taxonomy regulation, but if you also think of the sustainable finance disclosure regulation and other pieces of the framework, if the coverage is only limited to where we have, data, then it risks to be very limited in some cases. So if you think of banks, if you cut out the whole SME lending, which is an important part of the balance sheet, then of course the coverage is rather limited, and it might fail to give a reliable picture of the greenness of the bank, because it only looks at where the light is. So as an economist, of course, my job is to find a solution, and I personally, of course, have nothing against estimates. That's my job, right, to develop estimates. But then, of course, as a policymaker, you immediately think of the risk of greenwashing, because with any estimate always comes the risk of overestimation, be it done on purpose or simply because the methodology behind leads to an overestimation. But when it comes to greenness, this might be called greenwashing. So it's a really fine line that we are walking to try to strike a balance between devising disclosure requirements that are informative and useful for the market, but also minimizing the risk of greenwashing. And that's where we are also offering our scientific support.
Thank you so much. And yes, the precautionary principle which Andreas mentioned, it's also enshrined in EU legislation, the taxonomy legislation, and many others. So maybe, Andy, do you want to respond to the estimates part, and then we open up for a question online and in the room?
Yeah, so the precautionary principle works well when you estimate KPIs or indicators where the higher, the less desirable. Because in essence, you can just overestimate. It's a lot more tricky when you have something like green taxonomy, where it's the higher, the more desirable. So in essence, you would have to continuously underestimate, which you can do, but it's technically a little trickier than to simply overestimate the other way around. And also, of course, you need to then define a very clear test. So for instance, out of those that accurately reported, the model would estimate 90% under for something such as taxonomy. You still may give some people credit for something they haven't done, which is quite costly for those who do it. So in essence, from a data integrity perspective on taxonomy, it might be worth reflecting to what extent simply trying to get the banks to actually get others to do it, maybe in a simplified version for SMEs, but in the same way for non-European issuers, which if they have European subsidiaries will have to come in based on the largest subsidiary just a few years later, would allow us to actually get more data. And in many ways, getting companies to be transparent about the split of their capital expenditures, if you wanted to extend this R&D expenditures, the ventures and investments, I think that would be hugely important. And quite often, what we forget is that the financial accounting systems we're using are in themselves not 100% accurate. There's a lot of uncertainty there. There is restatements on the financial accounting side. And B, they're not necessarily fit for purpose when it comes to sustainable finance. To provide a simple example, right now there is dozens of companies whose revenue from the last fiscal year, the actual revenue number, is negative. Not the profit, the revenue number. That is because revenue includes both ventures and investments, and if you sell them well below book value, that's simply a negative revenue. So if you look up the revenue of Phoenix or Aviva, they're even negative 20 billion. Now, that happens across all industries. The reason it's a lot right now is because of COVID and commercial real estate that has been sold off enormously below a previously considered fair market value. But what does that mean for WACC, weighted average carbon intensity? If you happily divide by revenue, in some cases you're deducting your WACC because that revenue was negative, and then you end up having a lot lesser carbon emissions if you just execute the formula without thinking about it. And even more so, while you may hopefully spot the negative revenue and realize that you just can't calculate WACC like that, and you can ask the data vendors if they did or not, many of them just pushing out the WACC as if nothing happened, you would get into even bigger problems where the revenue may not have gone negative, but maybe 90% reduced by the negative components. And so we simply need to become technically more accurate and acknowledge the limitations in our IFRS-based financial accounting system, not with CAPEX, but with some other numbers. CAPEX, I think, is fairly fine, and they make pretty good judgments on this. And make sure that everything is fit for purpose for sustainable finance and the required regulatory accounting.
Excellent. So with that, let's open it for some, Isabel, if it's okay, another just 5 minutes, if there are questions in the room and online. So let me look at the room first.
Well, thank you very much for having you here. I was listening to all of you very carefully, and I have to say that I'm sorry for having a very down-to-earth question. But I mean, it's not directed to any of you specifically. It could be any panelist. But in fact, at the end of the day, what investors want is profit, right? So I was thinking to myself, how does sustainability considerations affect the traditional risk-return approach? Because at the end of the day, this is all related to what the financial markets stand for, what they want, and we cannot command them. So what are your comments on that?
If I may, so profits actually mostly are priced. They're not that relevant for investors, and even on the accounts, they're massaged by the companies. Investors quite evidently want three things: cash flows, risk reductions, and actual fund flows. And so the most important for the investors will be the fund flows, which means A, that they get inflows because that's how they're earning the money, and B, that whatever they invest in is topical, and for instance on ETFs will be more increasingly bought by future customers. So right now, every time a patriarch dies, hands over to the children, the investment probably gets a bit more sustainable, so that's good for the investors. Risk reductions, and I think that's where we have to be very honest with sustainability. Pretty much most of the financially material sustainability criteria will reduce your risk. They won't necessarily increase your opportunities, but they're designed to constrain risks. And so return risk ratios, Sortino Sharpe ratio, is also pretty good for investors. When it obviously comes to the third point, cash flows, then sustainability does cost money. It costs money if you particularly run it through OPEX. If it's on CAPEX, you can maybe look at it slightly different, but in principle, it does cost money, but other things cost money too. So in essence, it's then the question of how good the cash flows come out. If we look at the financial performance of Paris Line benchmarks, for instance, they started fantastic with COVID, because basically the exclusion of fossil fuel did really well. They were shocked for about 6 months with the start of the Russian war, but right now with the ongoing war, the expectation has changed. So by now they are gradually picking up performance. I would not say that they necessarily outperform on just a returns basis, but a return per unit of risk they do well. And frankly speaking, it's competitive performance. Investors, as compared to companies, have the beauty that they have 10,000 securities to choose from. So to actually put a sustainability consideration in investment portfolio can easily be done at a competitive or even enhanced return risk ratio. Companies are always different. So if you look at an individual company, they can't turn around that much. They don't have as many choices. It's really much easier for a CIO than a CFO to turn the company around. And I might go one step well beyond your question. It is the hardest for the union head to turn around, because the union head is stuck with the qualifications of the people, can't even invest on another side. And so we always need to keep that in mind. There's a lot of resistance, and the unions are relatively polite in exercising that, from the unions, certain unions in particular, because they really struggle through transition.
Maybe if I can quickly add one thing. So Andreas already explained the point on risks, which to me is really the crux of the argument. It's because it's in their interest to invest away from harmful activities. That's why they do it, not necessarily because they are, concerned about the planet. What I would just briefly add is the importance of policy and how investors react to policy signals. So I have myself at least a couple of papers where we show that on prices and quantities, investors have immediately reacted, for example, to the Paris Agreement and the withdrawal of the US from the Paris Agreement, and when Biden got the US back into the agreement. So you can clearly see in the data and in portfolio allocations and prices that investors very easily and very rapidly reacted. So this shows once more that investors move towards green or less green, clearly depending on what's in their interest, based on how they read economic and policy signals.
Thank you so much. We have one more question in the room, Fabiola.
Yeah, just following up on what was just said, we talked a lot about all these great green tools and how it's looking very promising. We're going to get green activities right, but that's just the green part. And what we just touched upon now is what is the new buzzword, just transition. So how do we get the social angle right? Because it's the unions on the one side and the qualifications, but we also see it in the population of countries. So policy signals, you were saying, to investors, but we also see policy reactions in population. We saw France and the Yellow Vest movement. So what's the next step, both from policy side and investor side, to make sure to get everyone on board? And there's a lot of definitions of just transition. So you can look at national level, so within a country, different economic situations, but then we also have the global perspective. And it's great if Europe goes ahead, but yeah, Europe alone is not the globe, so.
Would you like
Oh,
to
why are you
start
looking
off
at
the
me? I mean,
policymaker
so
side?
this is a question that's much above my salary band. But so what I can tell you, like much more down to earth, what we have been doing at the very technical level, for example, in the context of the taxonomy, the platform has worked on ideas how to possibly develop in the future a social taxonomy, which is even more difficult than an environmental taxonomy, because in an environmental taxonomy you can have clear thresholds in terms of, you know, so much pollutants in water. But in terms of a social taxonomy, you can imagine how difficult it is, but we do have at least a roadmap with some indication from the platform. In the context of the corporate sustainability disclosure directive, corporate disclosures, we do have very many indicators on the social and governance part. And this will apply gradually to many companies, up to 7 dozens of thousands of companies. So, you know, there are policy initiatives in that direction, but then, of course, the issue is very, very important and needs to be monitored.
Thank you. Just something on that question. I always wondered, how do you, right, the question in the just transition is, how do you phase out the business model and protect the people? And arguably also it comes the same with executive teams, right? Many of the executive teams have no clue what the actual people, you know, if you're a person leading a company and you're in London, listed on the London Stock Exchange, you probably don't know what people in Aberdeen and the UK are doing on the oil platforms, right? So you want to protect them, but you need to have very harsh discussions with the people in power who we know lobby not always in the best interest necessarily of their own people, because climate will impact us all.
I think it's key that everything we develop is flexible enough to be applied in emerging markets. As you could see in emerging markets, CTBs are more popular than PAPs, so having both enables us to play both, if you want, to the fastest possible transition as well as adjust. It's likewise keen to just have a lot more data and information on all of this, and actually, for instance, have semi-independent data on economic activities in various African states. The UNFCCC defines 69 countries as particularly needy. 69 countries out of a total of 190, depending how we count, leaves another 120. Of these 120, there is still about 40 that don't even have a financial market. Right? When we in financial market terms talk about developing in frontier markets, that's only 72, 73 countries. There's a lot of other countries that don't even have a financial market. And so in essence, having more information on that and being just to all the citizens of the world, current and future, I think is very key. And I think that also is another consideration. Just transition for me personally doesn't mean retaining all coal jobs, much the opposite. It means being fair to the current and the future jobs, and potentially on some of the coal jobs just being frankly clear that, you know, that is a job that would harm future generations' interests substantially.
All right. So with that, can I ask if there's one last question online? No, timeout from Isabel. So because we have a timeout, please join me in thanking Lucia and Andreas for really wonderful contributions. And with that, we conclude.